Hello folks, welcome to this presentation of earnings event calendars. Earnings event calendars. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Folks, calendar spreads have been discussed for many years, often in the context of income type trades, where you could put them on seasonally every month and have them be a fairly good, reliable source of routine income. All right. Well, we have discovered through recent advances in modeling, and certainly in the early, from 2010 onward, that really isn't the case. It's not that reliable of a strategy in that context. And so what we have done is at OptionVue here, we have come up with some great modeling advances, and we're going to use those advances to exploit earnings events. All right, and we're going to use calendar spreads as a strategy to exploit shifts in volatility that occur leading up to earnings and then also after earnings come out on a given stock. All right, so there are two types of calendar spreads, and I'm assuming that you've watched either the horizontal spreads presentation from level 2, or you're coming to this session at level 3 with a good understanding of what calendar spreads are in terms of a horizontal type trade. So I am assuming a degree of pre-existing knowledge about calendars when we go into this. Okay, so let's look at the two types of calendars we're going to take a look at here. Number one, T1 calendars, or T+1 calendars. We call it T1 for short. That's because they're put on the day just before earnings are announced, just one day prior. Okay, now T+30 calendars, or T30 calendars for short, those are placed approximately a month beforehand. Approximately a month beforehand. As soon as you know when earnings are going to be announced on a given stock, you can analyze it, and we'll show you how to do that. But as soon as we know, roughly around a month away, that's when we want to place the T30 type calendar spread. So we're going to look at both of these. Let's go to the T1 and take a peek here. T1 calendars, look at the top, placed the day before earnings are announced and then removed immediately the next day at or near the open. You may want to wait for the option prices to settle down, for the spreads to get a little bit narrower right at the get-go. All right, but after earnings are announced, the volatilities are going to shift dramatically right at the open, and that's when you would remove the calendar spread. So we're going to discuss here the opportunity going into this. We'll show you how to find the opportunities, and then we're going to look at an example opportunity using OptionVue's Trade Finder. All right, so let's look at the opportunity. Here is Google, and this is from January 29th close 2015, just prior to earnings being announced before the open the next day. Okay, so I want you to take a look at this, because you'll notice that for the expiration on 131 right here, okay, take a look at these implied volatilities. Now this is just 2 days before the expiration here. The MIVs are much higher than the next day out. Do you see this? Excuse me, the next expiration. Then let's go to the next expiration beyond that. Obviously, we're looking at weeklies here amidst everything else. All right, do you see these? Do you see that horizontal skew going on? That the front expiration has a much higher implied volatility than the more distant expirations, both in the calls and the puts. Now, when earnings comes out, okay, when the announcement hits and then the open, all right, hits, look at what happens. This is 30 minutes after the open the next day. You could see here pretty much, now that January 31st, that was a Saturday, so here we are on the 30th. This is the final day of trading, and because there's just less than a full day, you have no MIVs able to be recorded or calculated. However, if you look at the money premium, look up here, you have roughly just over $10, okay, of time premium in this 510. That's the at the money option, over $10. Down here, you have roughly $2.55 of time premium. So from $10 down to $2.55 overnight for the at the money option. So these MIVs obviously plummeted, but look at the other expirations. Look at this one, down to the 19s, and look right above it. The February 7th was in about the high 30s, low 40s, a dramatic shift. So leading up to earnings, you have tremendous amounts of these time premiums are allocated towards that earnings event. There's a lot of expectation that Google is going to gap, and indeed it did gap. You could see that, almost $15. So there's an anticipation of a gap, and in anticipation of that gap, the options then have higher time premiums, and those are reflected in the calculated implied volatilities. At earnings then, the gap is known, all right, and then that premium amount allocated towards that gap expectation now gets immediately removed from all the option prices overnight, and now down at the bottom you could see what the adjusted MIVs now look like. Now what's great here is that OptionVue takes a real good stab at calculating how much these volatilities are going to shift. Using past implied volatility levels, past gap levels, past statistical volatility calculations, OptionVue has an internal variable volatility model that takes all that into account and will then make a real good prediction as to where we're going to go from the top part of this screen, what the screen underneath should look like, so that we can model how much what a calendar spread would do in this kind of situation. So let's just go to the next screen here. I think you get the picture. How can you find these types of skews where you have the front expiration so much higher than the more distant expirations? All right, now I wanted to show you this too. Do you see how in the front expiration these MIVs in the 70s dropped to, well, we can't really see what the calculator, but let's say it was 19, it's at the beginning of the day, $3 with the rest of the day to go, but let's say it was 18%, going from 69, 72% down to 18 or 19. That's a dramatic drop. Go out to the far distant one, March 21st. These were in the 24 range, dropping down to the 19 and 20 range. Not as much of a drop. You see that? The front expirations dropped far more dramatically than the distant expirations. So that's what the idea here is, that we want to sell premium in the more front end of this matrix, because the short premium over here is going to benefit greatly by the huge drop in implied volatility, whereas the long premium way out here in the distant months should hold its own. Yes, it's going to drop in MIV, but it will hold its own far better than the front, and so a calendar spread will take advantage of this volatility skew snap effect. So when we go and look for opportunities, we want to find situations where the front expirations have much higher implied volatilities than the distant expirations. Okay? So let's go look at finding the opportunity here. There's three ways we can find opportunities: OpScan, earnings search, and then I'll give you a little peek at our earnings module a little bit. All right, first of all, in OpScan. In OptionVue, you would click the OpScan button at the top, and you can create a brand new scan if you would like, and you would just click New and fill it in with these items here. Horizontal skews, you can label the title as you wish. I want to simply look for all the stocks that trade over $1 million. This is in thousands of dollars, and you have 1,000 there. So That's really the at-the-money, the 10-day average total dollar volume of options traded is over 1 million. You could certainly adjust that if you want. But we kind of like that. It gives good liquidity, and you should be able to get some good fills. On the sort line, we're going to take all those stocks trading over $1 million a day in options, and we want to find those that have a very high front month implied volatility relative to the third month implied volatility, IV1 divided by IV3. See that? Okay. And then in the show line, we're going to create columns for IV1, IV2, IV3. We want to see the dollar volume of options traded on average, and then we want to see what the actual stock price is. Here's just a sample report as of March in 15, and you can see here then the front month is far higher than the second, which is higher than the third. All right, and you have a strong horizontal skew here, and when you have such a strong horizontal skew, it's probable that these stocks are going to have earnings coming out fairly soon on these stocks. And of course, it's earnings season as we did this, and that was certainly the case here. So OpScan is one way to acquire a list of stocks likely with earnings coming out. And of course, you could throw these into the quotes display and then see what dates those have earnings coming out and analyze it accordingly. All right, let's go to the other way. Now, this is going to get you a list of stocks, although you're going to have to scan each matrix one by one to see what the skew is. But this is a way of getting a complete list of earnings coming out, and that is in OptionVue, you would go to the top right corner, click that E button, and that brings up an earnings search screen. Come down to the bottom here, fill these items in accordingly. You can select all option stocks, exclude stocks priced less than a certain number, and you can exclude stocks with a DVO, dollar volume of options traded, less than a certain number. Now I just put 100 there. You could bump that up to 1,000, and then that would be $1 million effectively. All right, so I wanted to point this out because this is a more comprehensive way of getting a list of stocks with earnings coming out. Now, this report will not help you find the skews that we're looking for, but at least it gives you a list of stocks with earnings, and you can then, as I said before, scroll through the matrices looking for those horizontal skews. Finally, OptionVue does have an earnings plays module. There's an additional cost relative to your OptionVue cost. You have to pay a little extra to get the earnings plays module. A part of that module includes, well, there's 5 items here. One of them is called prime non-movers, but as you'll see at the top, 5 strategies covered by the new earnings plays module are, okay, let me take this, zip, okay, prime movers, that is stocks that make big moves. Options tend to be undervalued. Prime non-movers, and this is what we're looking at, prime non-movers are stocks that make smaller than expected moves, and the options tend to be overvalued, and we're looking at using calendar spreads to exploit those, especially those that have the skew that is going to likely snap. There's an earnings pairs portion, 2 stocks in the same industry, only one of which is announcing earnings, and then you have echoes and runners. All right, so we would look at the prime non-movers typically here, and in the module itself, you can have this portion here where you have the prime non-movers be limited to just the good calendar candidates, as you'll see here. Okay, the quality rating is the expected return on that calendar spread, and once you set all these in place, you would hit go, and you would get your list filled in on your quotes display. So what the earnings module does is it fills in your quotes display with 5 additional tabs, each tab of which is going to have a list of stocks. Also, the earnings module comes with an earnings planner that will tell you exactly at the open or close what to do if you're going to play everything. open this particular play, close that particular play, etc. All right, so here's an example opportunity on a T1 type calendar. T1. Now this is a prime non-mover that's appeared for several months here, Google. And you could see in this particular example, the earnings date was April 23rd after the market close. The expected return on a calendar was 29%. 5 of the last 8 calendar plays had been winners. It trades, good grief, about 18 million in options a day as of April of 15. All right, so here's a definition of prime non-movers within the module. These are stocks that make smaller than expected moves. You buy a calendar spread or sell a straddle on the day prior to announcement and close it on the day of the announcement. Selling the inflated options pay off because the options tend to be overvalued apparently prior to announcement. So, in your Discover Options classroom, you'll see an item there called Stock Analysis Report. Within the body of that report for Google, as of this date, you can see then the last 1, 2, 3, 4. Well, these are the last 7 earnings that I'm showing you here. And the way you would read this is the announcement is after the market close on that date. If the announcement is after the market close, then you would then go to the next day at the opening where you'll see that there's a gap level. So Google in this case typically gaps roughly 1 to 3, between 1 and 3.5% at the open, and then it can wobble around a bit. Here's one large gap, well over a year ago. But everything else is roughly 1 to 3% on the open. So, with that information in mind, we're going to go and look at the matrix for Google, and we're going to let TradeFinder find the best calendar to exploit our situation here. So, just want to show you here, Google on the price chart, you could click this E button, and it's going to bring in the earnings dates. You can kind of see that down there. All right, just take a look there. And so we know that, we're sitting here in April, just before that 4/23 date, and we're going to go ahead and now take a look at a few things. I want to make sure, if you use TradeFinder, okay, you want to make sure your slippage level is set on small. If you use TradeFinder, make sure your slippage level is set on small. If you have no commissions and no slippage setting, well then TradeFinder is the contract levels will be huge because it's assuming that there's absolutely no slippage and no commissions. And slippage and commissions can dig into your yield quite a bit. Your contract level would go down if you have slippage set on small, and even 50, 70 cents a contract or more. That will make a difference on your TradeFinder results. Also, I want to make sure that if you go into doing this calendar spread in TradeFinder, you have to make sure that your matrix has 2 years of data, and you want to include leaps here. So you want to have your standard options set at least 5. You want to have weekly options coming in certainly, and you want to have leaps coming in as well. You could have quarterlies if you want, but it's most important that when you go and look at the matrix that you're going out roughly 2 years or so that we get a complete set of data for the modeling process to take place accurately. All right, so we have our matrix filled in. Look at this, we're going way out there, a couple years, including the leaps here. We have a good set of data in this matrix, good prices coming in. Now we click on TradeFinder up here. Now mind you, if you click TradeFinder and you direct it to analyze trades in a matrix that has bad prices, no good. All right, that's a bad thing because garbage in, garbage out. And I'll tell you what, Trade Finder is very, very good at kicking out garbage because garbage went into it. All right, I kind of view it like a thoroughbred racehorse. If it, a thoroughbred racehorse is an amazing thing to watch. We just had the Kentucky Derby. I mean, amazing animals. But you know what? If there's a little bit of an injury on any of the horse's legs, even a minor one, it will dramatically impact the results of the race, even if a horse has a minor injury. Okay, so Trade Finder is the same way. The data has to be pristine for Trade Finder to really hum. And with good data coming in, you're going to have awesome results here. So watch this. We're going to click Trade Finder. It brings up a screen where you have 6 tabs. We'll address each of these tabs relative to the Google matrix that we have here. So Google is trading around 508. We have good data. We're going to bring in selected assets. We're going to bring in Google. Then we're going to click the next tab labeled Targets. And in Targets, we're going to select the target for Google. Where is Google going to go in one day? All right, now when you bring this up, okay, let me go back just a second. Okay, I don't see that part. I was just checking on something. All right, when you go into targets for Google, you're going to notice something, and that is down in the bottom left corner, it'll say implied volatility change, and there'll be a number there. That is the expected IV change in the front expiration that is affected by the event. So in this case, if that's a weekly set of options there, that front week is going to drop almost 50 percentage points, 50 points, from 70 down to 20 in that front weekly expiration that we saw in the matrix. So when you see a number here under implied volatility change, you know that there is an event being modeled internally here. And it's certainly most likely related to earnings. So for our purposes, we don't know which way the stock is going to gap, right? We have a pretty good indication it's going to gap 1 to 3.5%. We don't know which way. So we're going to go ahead and under target type, use bell curve. We're going to click this button and bring in center price. Now a little nuance here is you then have to go down here to the date, type in T+1, click enter, and when that happens it will then activate this little second bar, the second button right here. Now if you click this left hand button, it'll bring in the current statistical volatility. If you click the button right there, that's going to bring in the implied volatility related to the event itself, just the implied volatility, or the volatility implied for the event from the options. The options are implying a certain volatility level related to just the event, and boom, that's the number we're going to click to bring in here. So the bell curve is going to be fairly wide just for a one-day basis. Again, we don't know which way. We want to make sure the bell curve is wide enough to account for it. And we're going to see if there's a good calendar spread that encompasses such a wide bell curve and has a good positive expected return. All right, so with that done, we click the next tab over, Strategies, and we're going to select horizontal debit spreads. That's a calendar spread. Okay, make sure down in the bottom left we're including both calls and puts, and that's going to be about it for that. Let's go to the next tab over labeled Goals, and in this case I'm just using $1,100. Calendars are not very expensive, so you can put in the amount you want, but again, make sure that you have some slippage and commissions being modeled here. Next, we click the Filters tab, and here's where we can say minimum price to buy of a certain option, minimum price to sell, and you could play around with a few other things, but But the thing that I did here is, and you can use these calendar qualifiers up here. The minimum days remaining in the life of the option to sell, I'm putting at 10. And the reason is because I want to create a calendar spread where I'm making sure that the short strike is in the front two expirations. Okay? If you leave that box blank right there where the red arrow is, well, it might find some relationship way out in the distant expirations. And it's going to exploit that distant snap of the skew way out there. And that's going to be a little bit less reliable than knowing that the front one is going to collapse completely. So I want to focus the short strike in the front two expirations. You may want to try and limit it just to the very, very front one. But again, go ahead and experiment with inputting different numbers there, and you'll kind of see how it does affect the Trade Finder results. All right, let's go to the next filters tab right there. I'm going to leave these blank. Certainly if I were selling condors, that's where we're doing, or strangles, that's when we're doing these standard deviation shorts out of the money like this. Okay, we then have our information. We click the Go button. It cycles through all the possibilities. I like to use probability of profit because I want to make sure that I'm enveloping as much of that bell curve as possible. And then I'm going to go to the higher probability of profit trades that have nice fat, top expected returns here. Okay, so 72% is pretty good. Let's take a look at that top one right there. Okay, and that looks like a 3-lot trade at the 5:10 mark, real close to being at the money. And we're going to click on that, and then I hit, in this case, I'm going to click Send Trade to Matrix. When that lights up, it'll send it over here, and there it is. Now notice that it did not put this short strike in the front expiration here. Even though this is going to collapse, the variable model is predicting that this is going to collapse as well. And when you model this calendar relative to all other calendars, this calendar will have the highest probability of profit of all of them, with a pretty decent expected return relative to that $1,100 number. Okay, now I'm going to click Analyze, and this is analyzing it using the variable model that is including the skew snap. All right, once again, this picture, okay, is modeling the skew snap. So look at the bottom left corner here. Expected event modeled at T+1. When we look up here, we can see we're highlighting T+1 right here. And so that you'll see that if the skew snaps like it's being predicted and the stock does not move, well, this is going to make, probably close to 90% on your money. Yeah, look at that down there. 91, 94% on your money if it doesn't move, if it just sits there. But we know it's probably going to gap 1 to 3.5%, right? Okay, another thing to look at is on the left side. Volti change, do you see that minus 49.9? Remember what that is? That is the number of the vol drop for the front expiration cycle that's affected by earnings here. And when you have a big negative number there, and you have expected event modeled at T+1 there, you know that that's related to earnings. And we can go and take a closer look here. Let's do this next screen. There we go. I want to make sure. So you're looking at this Volti change number. There's this little ellipsis button. You see that? If you click that, that'll take you to a screen where you can really dive in and take a look at how much that skew is snapping and where it's being predicted to snap to. once again, in this model volatility screen, you can then see where the volatility is expected to snap to, so that that front expiration that drops 49.9, it's going to drop 49.9 down to a volatility of roughly 21.3. Okay? Now, you go out to the next calculated implied volatility level, 60-day, 90-day, 1-year, 2-year. Now you're at the 21, 24, etc., going on out to 2 years. And again, you need 2 years because it uses this data to help fill this in. You see, this is going all the way out there. All right, and this is showing you the predicted skew snap as of that future event date. Okie dokie. All right, one moment here. Okay, so that is the model volatility screen showing us the skew snap. Google ended up gapping roughly 3.4%, and it went to the upside in this particular case. It went to the upside to roughly 525 overnight. Okay, earnings came out. Okay, the gap's up almost 3.5%, and this picture goes to, and let me show you what actually happened, is it went to there. And the position made close to 60% on its money right there. See that? About 525. That's the gap, and the calendar ended up making money in this particular case. So there you go. Not too bad. It's a great example of what can happen, and for our purposes at least, your homework is to backtest the last 4 earnings in Google, and your mentor might give you a different stock because, you know, we're as we speak now, we're in the spring of 2015. In the future, though, your mentor may have other stocks he may want you to try instead. Okay, just conditions change, etc. So there you go. All right. And here's the. And finally, I just wanted to show you here, where did the skews snap to? In this case, that short went to 18.3. The long is at 20.4, and there's your gain loss. Now let's just see, where were the skews before earnings? And there it is down there. Our short strike when we sold it was at 38.7. It dropped to 18. Then over here, it was at 25.8 and dropped down to 20. Okay, so clearly the longs held their own much better than the shorts did, and so there's that skew snap that they, more than made up for the 3.5% gap. So worked out very well. All right, so that is one type of earnings event calendar for you to consider. That is a short. Obviously, it's just a one-day play. You can make good money overnight, but that is a strategy that we are far more interested in now for our calendar types trades, because we now have the modeling capability to evaluate our risk much better this way. All right, let's go to the other type of calendars that we like related to earnings. T30, T plus 30 days out. These are placed approximately 1 month beforehand, before earnings come out. Now, the idea here, let me show you where I'm going to show you the opportunity. What you do is you place these roughly a month beforehand. You're then going to just put them on, and you're going to wait until you have roughly a 10% yield, and then you take it off. You're happy with your 10% yield. That's a good yield on a calendar play. All right, now if you get a 20% loss, you take it off at that point. All right, the race is on, and when you'll see in Apple, and especially in your backtesting work, I think you'll see that there's a phenomena here that's very interesting that I think is going to, you'll get excited about. Let's take a look at the opportunity. We'll talk a little bit about finding the opportunities, not a whole lot to talk about right now. And then we're going to look at a double calendar example. You can either use single calendars or double calendars that we talked about in level 2 to get wider coverage. So we'll take a look at a double calendar example here. Let's look at the opportunity. If you take Apple's earnings going way back a couple years, and again, you dial it up in OptionVue, click the E button, brings it up. We're going to go to the stock analysis report, pull up the last, how many? We'll take a look at the last 5 earnings. And I want to show you something here. I want to show you something because if you, in this case, look at this. January 27th is when earnings was coming out. If we go back a month beforehand to December 29th, okay, a month ahead of time, look at this. The expirations of these months, the expiration dates is January 24th, January 31. So, this front one will not be affected by earnings. This one will be affected by earnings. What you're going to find is that the expiration that is affected by earnings, the implied volatility here is going to rise, and the implied volatility of this front is going, the previous one is going to decline. There's going to be a widening of the spread here. And indeed, we could go to just about a week before earnings came out. Let's just advance forward 3 weeks and look at this. The implied volatility of the January 24th expiration held about the same. Look what happened in the January 31st, the one that is affected by earnings, it skyrocketed. See that? So if you did a calendar spread where you're selling this one, buying this one, the longs here are going to benefit from this rise in implied volatility, while the shorts just stay the same. Implied volatility stays the same. As you'll see, it can even go down. Let's go to the next previous expiration in Apple. Let's go to the October 20th, 2014 example. Let's go a month prior. Okay, a month prior. October 20th is earnings. The expiration on October 18th is not affected by earnings. The expiration of October 25th is affected by earnings. After 3 weeks, let's look at 3 weeks later. The implied volatilities of the October 18th dropped to 19.8. The expirations for the October 25th expiration went up to the high 30s, more than 10 points. So do you see how there's a widening of that difference? Let's go to the next previous expiration, July of 14. Okay? July 22nd is our date. Here's the expiration for the 19th, not affected by earnings. Here's the one, July 26th, that is affected by earnings. The one not affected by earnings went down about a point. The expiration that is affected by earnings went from 25, 26 up to 38. Again, so selling premium in the front expiration that's not affected, buying premium that is affected, going from 26 to 38 would be a huge benefit to this calendar spread. Let's go to the next one, April 23rd. Go a month before that, April 18th expiration, IVs at 17.4. 3 weeks later, they dropped a few percentage points. The one that is affected by earnings, April 26th, went from 21.6. Look at that. Went up about 15. Just a huge widening of that horizontal skew. And finally, here's an example. Now, I'm going to mention this too. I think perhaps there are cases where we just don't know when the exact earnings date is. And I have a feeling that in this case, folks didn't know exactly and they weren't willing to, speculate that when Apple's earnings was formally going to be. But you can see here from 33 down to 16, the one that is affected by earnings went from 32 up to 41. So what you can do is you can advance forward in your backtesting work, and we're asking you in homework to do this. Just go forward until you see a skew develop, and it's pretty certain that that's when the date was that Apple, in this case, announced the date of their earnings. But they pretty much are kind of like clockwork. But that's kind of what you'll find here. All right, so finding the opportunity. There's two ways to find the opportunity. Right now we have Apple that works like clockwork. And as we do more research, we will post that research on the inside wires in the ensuing months. Okay? And also, there's a possibility, and I've asked, that we might, have an earnings module edition sometime in the future. I can't represent that it is going to happen. I can't at all. I've put in the request. But right now, I would ask you to watch the inside wires. If you're a level 3 student, you have access to the inside wires for a strong period of time, and we're going to post any additional research besides Apple as we do backtesting work on other stocks. That's the primary way to find opportunities. And I should have put a third one. That would be your own research. Okay? Your own research, you can find stocks, go back, walk through the backtesting, and you'll find some stocks that do this. Hopefully, the earnings module may have a module where it exploits this phenomenon. As we speak right now in the spring of 15, that is not the case. Let's look at the double calendar example. In level 2, we showed you what a double calendar looked like. You can put on a single calendar and adjust it, using throwing on more calls and puts and balancing it. Or what I like to look at is the double calendar. Here's an example from Apple. This is March 31st, 2015. We're looking at that date because earnings was going to come out April 27th. So we use Backtrader to go back to a month beforehand, to March 31st. And that's when this skew first developed between this April 25th date, which clearly is not affected by the earnings date. The next month expiration out, May 2nd, is affected by earnings. You try and straddle that, on 1 week apart from each other. Is affected by earnings. This front one is not affected by earnings. We would expect this skew to grow wider. So when we model this, we're going to use a variable volatility model to get a picture that looks like this. Now, mind you, these lines, and you can see here volatility change, okay, it's being factored in. These lines include the shifting vols as we approach earnings. It is taking a stab at predicting that widening skew, in other words. Okay, and here you can see it's as of this April 28th date, but remember, the maximum projected date is April 25th. So this the big snapping of the skew isn't going to take place till after this. All right, so just keep that in mind. Here's the week 1, but this is after that 28th date. Leading up to it, you're going to have some adjustments involved that's internal. Now, I want to point this out because if you were to use another broker's platform that does not include a prediction of these moving volatilities related to earnings, okay, those platforms typically use an EIOIO model. That is, each individual option's implied volatility will stand on its own in the future. If you assume that this 32 was going to stay 32 indefinitely into the future, and this 23.7 was going to stay at a 23.7 indefinitely in the future, you are selling premium that is much, much lower than what it is you're buying. That's a huge disadvantage. Okay? If you model this calendar using what's typically out there, you get a horrible looking picture. horrible. Absolutely horrible, because in fact the daily time decay on these longs turns out to be much higher than what you're getting on the shorts, such that your theta actually turns out to be negative instead of positive, like on a calendar would have if these were the same implied volatilities. Because you're selling these for such little implied volatility, such little time premium, your theta ends up being negative. And that's what it looks like. You lose money every day using that model. But because the skew is going to widen over time, OptionVue will model that, knowing that earnings are coming out and the skews are going to widen. That's what's being modeled here. This is pretty advanced stuff here. Okay, so this doesn't look, this is looking terrible. Now, watch this. When we go forward in time, and it takes about a week. What are we going? March 27th to April 2nd. Okay, we finally have our, and we go to the close on each day. I just, go to close to close to close. Here's a close on April 2nd where we easily have our 10% yield. Okay, far more than our 10% yield. And I can model it using variable, or in this case, you can see how it's being modeled. Even with the variable in this case, it's showing that we are making money right there, about 18%. Okay, in fact, I'm not certain. It says variable, but when I pulled this screenshot, I'm pretty certain that's variable. At least it's I think the skew is already. I don't. This isn't sunken so much, but yet it does show. I believe this is probably a EIO-IO model, but you can see here that the situation is such that the skew widened and the position is making money. Also notice that on the double calendar, you're really widening it out such that you have a much higher probability. Okay, your 10% yield is going to be a little bit less than if it was just a single calendar right in the dead middle like that. But in this case, you don't really have to adjust. You just put it on, wait, and if you're down 20%, well, then take it off. But because that skew is going to happen, this whole thing really shifts straight up, and it's a good situation, okay? All right, you have homework to do. I want you to do the homework. I have some simple questions for you. Fill in the blank, a little bit of essay work, okay? And then backtesting work, where you're going to backtest. Start with Google and Apple. The T1, we want you to do Google. The T30, we want you to do Apple. And see how it goes. Get with your mentor. Go through your homework. He might have other stocks for you to do as well. He'll have some other insights. But that's it for this presentation. Thanks for listening. We hope that these strategies, working with OptionVue's tools, will really help enhance your trading profits. Thank you very much. Have a great day. Bye-bye.